Welcome to our Proactive Tax Planning Workshop. This is being taped on March 26th of 2021. Today, our goal is to provide helpful information for those who have not yet filed their 2020 taxes and also proactive for tax planning year 2021, and then end with some investments. Although before we get started, that this is just a tax taping, we want to emphasize that our office does all 5 of these planning areas. We want to be proactive versus reactive when it comes to taxes, so let's get started for 2021. There are 7 brackets for 2020. The lowest bracket is 10% and the highest bracket is 37%. You have single, head of household, and married filing jointly, major categories. And at the bottom of this slide, you can see the standard deductions that are appropriate for each area and category. Should you itemize, a major change that still has a big impact is the 2017 Tax Cuts and Jobs Act. That's known as SALT. Its state and local tax deductions are limited to a combined total of $10,000 for married taxpayers or $5,000 if filing separately for state and income property taxes. This deduction limitation is planned to stay into effect for 2025. These are the capital gain rates, and they are extremely favorable still, 0, 15, and 20%, and those also were enacted during the prior administration. We look at charitable donations for those who itemize, and also the CARES Act brought in for 2020 a $300 above-the-line tax deduction to a charitable 501(c) organization, and everyone can take this even though they don't itemize. It's line item 9 you can see on the tax form on the slide. Retirement plan funding is always something that you should consider. If you have not already funded your retirement account for 2020, there could still be opportunities to do so. There are some main areas that I want to mention briefly that are overlooked tax items. One is reinvested dividends, and this is a calculation that is important for tax purposes. You have mutual funds and stock dividends that are automatically used to buy extra shares often. And what you want to do is remember to adjust that basis so that you're not overpaying in capital gains. You do have to keep great records and keep track of this. A second area is carried over items from prior years. This could be something like capital losses, charitable contributions, certain tax credits. Make sure you look at that prior tax return to not miss these items. And the third way is a charitable gift directly made from an IRA. Individuals can make these IRAs up to charitable gifts up to $100,000 and not pay a bit of tax on that gift. Now, let's look at some things specifically for 2021. The tax brackets have remained basically the same with slight COLA adjustments. Long-term capital gains are still currently scheduled at favorable rates. And it's never too early. Again, you can see the rates here for your retirement plan contributions. There's a $15,000 per person gift tax exclusion. A husband and wife could gift to a grandchild $30,000. Some ideas for gifting could be for a working child's IRA or even a grandchild's IRA, or gifting to a 529 plan. This is a tax-sheltered plan for educational expenses. The new above-the-line deduction for 2021 has now gone up to $600 for taxpayers married filing jointly. It might be helpful to you to formulate a 2021 tax projection. A qualified tax preparer should be able to review your 2020 situation and give you a good idea if, based on your information you provide to him, what your 2021 taxes will be. If you are close to a standard deduction level, a strategy to consider is bunching your retirement donations into a donor-advised fund. This example shows that you can do a contribution each single year and get a specific tax deduction on those first 3 bars, or you could bunch them all together in 1 year and get a much larger tax savings. The other side of the screen shows the donor advised fund, where you can gift and put in this registration and take the tax benefit all in 1 year, but your favorite charity you can give a gift whenever you want to, and that money continues to grow in that charitable fund the entire time. A critical area to review in tax planning is what we refer to as overall tax bracket family management. If you have retirement assets that are not in a Roth, then who takes the distribution can make a huge difference. Simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than yours. However, if your beneficiaries are in a higher tax bracket, then convert those from a traditional to a Roth IRA and leave that account sit and grow. Now you can use those monies tax-free, or you can, after death, of course, pass those to your heirs, and they can let them grow for another 10 years and take the money out tax-free. This is a key step to explore considering your marginal tax rate and your beneficiary's marginal tax rate. And it's something to think about. We can help you with it. For some people, a Roth conversion could be very helpful. They can help you lower overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs, or people telling you you have to take out an amount of money at age 72. Roth IRAs allow tax-free withdrawals to beneficiaries. Remember as well the qualified charitable distribution directly from your IRA. This is overlooked to a lot of people who gift to many 501c3s. You can take that RMD amount out, or an amount up to $100,000, and pass that to the charity tax-free. Now, we do have a new administration, and we are expecting some tax increases. Those proposals are as follows. The corporate tax rate under the prior administration, the Tax Cuts and Jobs Act, reduced those corporate rates from 35% down to 21%. And we have had a pretty booming stock market since that time. Volatile but booming. And now the administration plans to take those taxes back to 28%. For those people over $400,000, the bracket will move to the highest rate of about 39.6%, and it would look like this. Capital gains for those making over $1 million in income will also go up, and it's staggering how much that will go up for those few people in that income bracket. It looks like it's almost a double, and the bracket would go from 4 to 3 rates. This slide is a bit confusing. There's a lot on it, but it just shows an example of a $40,000 deduction is capped for those in the 32 or 35 or 37% tax bracket. The biggest benefit on that $40,000 would be $11,200. There's going to be a phase out of small business income deductions for owners over $400,000. And this is an area of concern because I worry that it will detrimentally affect small businesses. Another major area of concern is the loss of stepped up in basis. His proposal for this administration is to take that away. And this will affect heirs dramatically because their basis now will be their grantors' basis where they bought the asset rather than the stepped up date of death basis. The estate tax exemption is now $11.7 million, and not too many people have to be concerned about it. However, a lot more people are going to be concerned when the estates are at $3.5 million and are taxed, which is the new proposal. Okay, enough on taxes. Let's take and turn towards the investor outlook for 2021. Quickly, the stock market ended 2020 at all-time highs after a waterfall drop and the quickest downward decline this century in March of 2020, fueled by the largest federal government stimulus ever, historic support from the Federal Reserve, and optimism about how quickly the economy is likely to bounce back. The S&P stock market index, the most widely watched barometer of the equity markets, finished 2020 up more than 16%. The fact that a pandemic-induced economic shutdown of epic proportions was absorbed by investors and the year ended with stocks at a higher level is historic. In March of 2020, investors saw stocks plummeting 34%, starting a bear market. That bear market turned out to be the shortest downturn in U.S. history. Since the U.S. stock market bottomed on March 23rd, the S&P has risen 68%, shattering all-time records along the way. Clearly, investors who stayed the course were rewarded. While these equities climbed higher from their March lows, not all stocks recovered to positive territory. In fact, as you start analyzing the year-end market highs, gains in Apple, Amazon, and Microsoft alone accounted for more than half of the S&P 500's 16% total return for the year. If you remove the 24 performing top companies dominated by techs and digitals services, the S&P 500 return for the other 476 companies would actually be negative for 2020. Interest rates weren't much help for investors in 2020. They started 2021 at or near historic lows. Federal Reserve Chairperson Powell announced again at their December meeting that interest rates will stay close to zero for foreseeable future. Congress also enacted approving a $3.5 trillion emergency relief stimulus during 2020, and this was the largest action in the face of a recession in U.S. history and provided some of the biggest aid packages in the world. Entering 2021, as this chart shares, interest rates are 0.09 for the average money market and 0.16 for the average 12-month certificate of deposit. Both those rates, clearly less than 1%, can be very unattractive to income seekers. Perhaps nothing has been more puzzling than the disconnect between the equity markets and the economy. The market's rebound reflects Wall Street's optimism about prospects for 2021. But it also accentuates the disconnect between the stock market's wild success and struggling American households. Wall Street is at all-time highs, but many places are still experiencing shutdowns, high unemployment, overrun hospitals, and economic hardships. Sadly, many local businesses like restaurants and gyms and small shops may never even reopen. Everywhere you turn, you are reminded that there is a deadly pandemic that is responsible to date for more than 340,000 American deaths and has also left millions jobless and hungry. In fact, as these statistics share, as of the year end, the COVID-19 daily cases, daily deaths, and hospitalizations were all peaking to their highest levels. Our goal is to make sure that your investing plan is centered on your personal goals and timelines. For 2021, caution is still the principal notion for investors. Let's look at 2021. Our job as financial professionals includes reporting and analyzing political activity and relaying how the new administration could impact the investment world. While all changes need to be monitored, some specific things need to be watched, and they include future stimulus, suggested tax increases, vaccine distribution success, and trade agreements. Many investors are wondering how the first year of the presidency will affect the market. While history's nice to look at, you can see that after a Republican presidency, the first year of a Democratic one doesn't look too bad. Meaning that the Republican reduction in the taxes likely affected the stimulus that we are now seeing. So what are analysts forecasting for 2021? Well, Barron's recently surveyed 10 market strategists and chief investment officers at large banks and money management firms on the outlook for 2021. Averaging their first year-end S&P forecasts, it ranged from 3,800 to 4,400, or an index rise of 9% in 2021 to about 40. Add a dividend yield of another 2%, and their forecasts show that U.S. stocks could return 10 or 11%. This panel also predicts the U.S. economy will grow by 5% in 2021, its fastest rate since 1984. That would be a healthy following a year in which gross domestic product had plummeted due to COVID by 31.4% in the second quarter. Even as the pandemic gripped the country, however, GDP soared by 33.1% in the third quarter. While this forecast now above seems optimistic, we like to remind you to that we consider your feelings about risk in the market when we review your unique financial situation and before we make recommendations. There's great optimism about how quickly the economy is likely to bounce back this year with the COVID vaccine becoming widely distributed. However, there are uncertainties. For example, what if the vaccination campaign in the U.S. does not run smoothly or as quickly as the investors of the market are expecting? Also, there is still a major risk in the economic outlook if the recovery is delayed and corporate revenues and profits fall short of expectations. 21 should be an interesting year, and our goal is to be communicative with clients on how things are proceeding. As a quick recap, 2020 was a year that rewarded discipline. Interest rates are at their all-time lows. There is a disconnect between the economy and the equity market, and a new administration brings new challenges. The effect of COVID-19 is still critical to investors. Peter Lynch reminds us in this quote, "You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready and you won't do well in the markets." So what can you expect from us? One of our main focuses is to review changes to our clients on an ongoing basis. You can expect regular communication, more frequent discussions, and you can expect that we are continuously reviewing economics, tax, estate, and investment issues for our clients. In fact, we will offer more workshops this year. We appreciate the opportunity to assist you with your financial needs. Remember, at our firm, clients come first, and your health and well-being is our highest priority. Do share this information with your friends. We also put out a monthly newsletter and would like to share that with your friends. Thank you again for your time today, and remember, a proactive approach can many times lead to much better results than a reactive one.